So welcome to our entrepreneurship and venture capital lecture series with Ed Rios today on the 31st of March, 2022. Welcome, Ed. Ed is a good old friend of Regent University. He's actually an alumnus of the university. Many years ago, you were my student.
Right.
Both of us got a little bit older, but we're still in contact. You are now, like me, a lecturer and a future professor back in the US in Houston. But you also have a track record as an entrepreneur, as a banker. We thought a few times about perhaps even you doing a PhD, and I would be your supervisor and so on. We haven't done that yet, but I think it's still on the cards. But more importantly, we've discussed some business in general, business opportunities, entrepreneurship, and so on. And we'd like to hear from you a little bit, perhaps if you can tell us a short intro about yourself, where you're standing at the moment. You're back, you lived in London for a few years. You're back to the US again. And I think you're now at the university and you know a lot about businesses, about startups, angel investments on. So around that context. So over to you, Ed. Thank you so much.
Thanks, Jacob. Thank you so much for inviting me today. I'm really happy to be here, and I'm really glad we could make the timelines work. I think it's interesting that both of us teach on Tuesdays and Thursdays, so that complicated it a little bit, but made it work. You know, honestly, I miss the train system in the UK, getting to and from places. But anyway, it all worked out. So just a little bit about myself. Jacob's absolutely right. I originally studied accounting, and I graduated a long time ago from undergraduate school here in Texas, the University of Texas, with a degree in accounting, and then did a subsequent work in that field. Ultimately, I lateraled to what I thought was probably more in line with my interests and really my skill set. So I became a commercial banker, and probably for the longest time did that. Probably 20 or so years was in commercial banking in different areas of banking, everything from government guaranteed lending to small business lending to what's typically called middle market, and then a little bit of corporate, but I there towards the end, I kind of lost interest because it all sort of became sort of a little too structured for me, and I wanted to kind of get closer and on the ground, where small entrepreneurs, micro entrepreneurs, were starting businesses. So I at that point moved to a company called Lift Fund, which is a micro lending. I'm not sure how many of the students may or may not be familiar with micro lending, but in the States, it's been, micro lending has been around for a long time, particularly in Africa and Asia, in Central and South America, where very, very small loans are made to, interestingly enough, primarily women who would in a village, say, start up a small little, anything from a sewing business to, insert name here. And then the village also of individuals who'd receive loans then sort of would look out for that individual and provide guidance. And so that's sort of the historical context of microlending. In the US, microlending is about the same, but a little bit bigger. The loan amounts typically these days are up to about $250,000 or $500,000. And what that's done, because microlenders aren't regulated by any of the major bank regulators like the FDIC or the OCC, they have a lot of latitude as to what they can do from a credit perspective. So what ends up happening is that a lot of micro lenders can do startup loans to otherwise to folks who otherwise wouldn't really have an opportunity to borrow money. Now, the notion of borrowing money for a startup is kind of contrary to anything you'll hear about someone who's starting a startup, obviously, because in the initial stages, you're going to do, you're going to bootstrap. Then you might look to friends and family. maybe then you'll have a true first equity round or something like that, or maybe go to angels. But I found that working a couple of years at Live Fund really sort of connected me with those grassroots entrepreneurs that were starting small businesses, and then from there had an opportunity to go back to the UK for a second time. Had been there previously in 09 when I did my master's and studied under Jacob, and made a great friend there. Easily, obviously, have stayed in touch. At that time, I did a postgraduate certificate at the University of Surrey in management education, which was sort of my lateral into education. So I've been very active now, obviously, in teaching as a lecturer here at Prairie View A&M. But I've stayed very, very connected to the entrepreneurial ecosystem here in Houston, primarily through a couple of organizations, some of my own work, and additionally, a long time real estate and property investor that, Jacob knows I've always had an interest in that. I've never really stopped being a property investor. And that probably stems from the fact that my dad has always been in property, and I've always sort of enjoyed that. So that's a little bit about me. What I'm doing right now, I'm teaching personal financial planning, and in fact, today, Jacob, we're doing basic investment theory. So that should be a class you remember. But really enjoying that. But when it comes to talking about entrepreneurship in the U.S. or in the USA, that's a lot to unpack. So I'm just going to kind of try to focus on a couple of things that I think are more in line with what I'm currently working on. I do have one question I'd like to ask the students who are there now, just out of curiosity, because I asked this question a couple of times, and I've had a couple of other professors ask this question as well. Do any of the students who are currently in the class this morning here, do any of you have any kind of a business side hustle or anything that would be construed as an entrepreneurial venture outside of school?
So over to you. Anyone wants to answer that? Any venture you are involved with at the moment?
Yeah, I guess.
Yeah, Ian has a venture.
So
yeah.
Trading in equities.
So you're trading in equities,
Yes.
but this is on a personal side or for a family or in personal side. So one of the students is involved in trading. More day trading or mid-term investment, long-term investment, crypto trading?
Bit of mix of day and long-term investment.
Okay, so one of the students is an investor, trader slash trader in the markets, in stocks. Anything else? Anyone else? Martin?
Yeah, I invested in private equity funds.
So one of our students, Martin, I think from France. Martin's from France. He's an investor in private equity funds.
Okay.
Anyone involved in businesses? Miduna, I think you did a presentation last week, but you have business ideas. You haven't started businesses yet. You haven't started yet. Some of the students are working at the moment on projects. Like this class here is about valuing startups and early businesses. It's all about creating value. I always say, like, the whole purpose of this class is, of course, entrepreneurship, but creating value, and in this creating value, thinking about how to value this creation of value. It's not just economic value, of course, has to do with non-economic values. Today, ESGs, as you know, of course, a big topic. I've written a few papers about that, and the university is very keen on sustainability and ESG ideas, and I myself as a researcher, but also as an investor, I very much look at that. So so that's the point here about the class.
Okay.
And the students are working on that. And over the last few years, we always had students here who started businesses. Some of them actually quite successful businesses. Some of them have already exited these businesses and starting again.
Correct.
Some become serial entrepreneurs. And so, yeah.
And let me just say to all the students in the class, what I've seen Regents do in the last couple of years, primarily this last year, which is unique given COVID, is now the outgrowth that you have in the incubator. You know, what used to be called the Hive. Educator down there is running that, and they've got a really robust program of an accelerator for any students that are interested. I'm still connected. I still sit on some of the panels, you know, from here, and travel usually to London a couple of times a year, and get to interact with folks. So I've mentored and advised a couple of student businesses that came out of the Hive there at Regents, and so I think you guys have a really interesting ecosystem developing. You know, I think now you're starting to see you know, real partnership between not just the Hive itself, or you know, the incubator accelerator program, but for professors that teach entrepreneurship. So I think Regents is going to be a very fertile place going forward, launching businesses, and so it's exciting to still be a part of it. So when it comes to entrepreneurship, I think it's always important to distinguish two things, or two differences, right? There are effectively what you would call lifestyle businesses, and then there are scalable businesses. You know, a lifestyle business is a little bit different, but there's no difference in the need to or freedom that comes with being an entrepreneur in a lifestyle business. A lifestyle business is something that's going to create a livelihood for an individual, you know, their family, send kids to college. So an example of lifestyle business might be someone who starts a plumbing company, right? And does real well as a plumber, maybe hires a couple of other plumbers, and maybe after about 5 to 10 years has a annual turnover of, say, on a commercial basis, $4.5 to $5 million, right? That happens. I've banked businesses like that. But that's very different than from, say, someone who's designed a portable toilet that can be put in areas of the world where there is no sewage system. You know, something that is scalable, like an Uber or Facebook, where you can grow exponentially, right? There's a certain limit to how big that plumbing company can get, and a lot of it has to do with the fact that it's run by one individual who usually is the face of the business. Now, both of those instances are entrepreneurship. There's no dispelling that one is less entrepreneurial than the other, because both of them have to put capital at risk. Both of them have to design a plan, and they have to execute and bring a product or a service to market. So when I talk about entrepreneurs, I'll be talking probably about both. I think that you know, if you look at for example, some of the businesses that have come out of the Regents Accelerator, I think you get a bit of both, right? You've gotten some lifestyle businesses, and then you've gotten some that are probably truly scalable businesses. And at the end of the day, the success of both of those types is going to have everything to do with the entrepreneur and, you know, their ability to execute on their plan. So I think it's always important to distinguish between those two. It's a function of choice, really, for the entrepreneur. But entrepreneurs in general tend to be pretty good critical thinkers. You know, they question, they sort of push the envelope. In most cases, are unwilling to conform to convention. And so, you know, as individuals, to be quite frank, they're a little bit hard to work with, right? I mean, I've had experiences trying to advise and mentor some entrepreneurs, and, you know, for as many times as I've seen something done a certain way, you know, it's impossible to convince them of the fact that, because they want to do it a different way, and that's okay. I think entrepreneurship is the classic what used to be called a liberal arts education here in the States. I think a classical education in Europe, where you studied philosophy, you studied English, you read history, and really developed critical thinking, out of the box kind of characteristics and personalities. So I think one of the lines of research in entrepreneurs that is really interesting is how the entrepreneurial mindset is not very different than someone that comes out of a classical training. So there's a lot to be done there, and I think some of the research is really quite interesting, but I'm sure there's more to come. I wanted to say a little bit about inflation, because right now it's top of mind in this country as well as it is in the UK, obviously, with gas prices being what they are, not just petrol but natural gas prices. The free flow of money that we've had in the last, I'd say easily 10 years since the financial crisis of '08 has created a very, very, very robust investment arena, if you will, environment. And then after 2008, primarily in the States, and I think there was similar type legislation passed in the UK and in Europe, it became a lot easier for individuals to invest either individually or as part of a syndication into startups. In the UK, for instance, I believe one of the organizations that does a lot of work with startups is called Startup UK. But what we've seen is what I would call a democratization of, for lack of a better word, angel investing. If you look now, there are literally hundreds of clubs that are angel investment clubs, and what they do in a series of a syndication can typically make an investment in a startup where the individual investors may put in, as opposed to the normal ticket of $25,000 or 25,000 pounds, maybe 5,000 pounds. So it's made the entry point into startups a lot easier. And it has become a bigger part of an actual, if you want to call it an asset class where you can make investments. I think prior to that, it would have been probably deemed, an exotic investment, where now, I think depending on who your financial planner is, they may actually encourage you to, invest up to 10% of your portfolio in up and coming potential startups. But the theory behind startup investment, whether it's angel investors or private equity, is obviously you need a spread of anywhere from 10 to 15 investments at a minimum, right? Because the fail rate and success rate is going to be pretty consistent along the way, right? And so from those percentages, you're probably going to, on an investment portfolio of 10 to 15 angel investments, you may end up with a couple of winners. You're going to end up with a good number that probably fail. And in the middle, you're going to have some that just kind of don't go anywhere. So in terms of setting up your portfolio, that's sort of the kind of thing you want to do. I lately have been doing a little bit of investing along with BAMA here in Houston. They actually have some representation in Europe, but BAMA is the Business Angel Minority Association. What I like about them is they're doing a lot of pre-seed businesses. So our investments are in safe notes. They're only bringing us a curated deal flow that comes really, well, two big criteria. The business is either has to be women or minority owned, and believe it or not, there are not a lot of those businesses out there. So we've seen a few in the last I'd say right at 2 years that I've been involved with BAMA. Made a couple of investments that we'll see how they turn out. But in those particular instances, what I'm looking for, or any other investment for that matter, obviously the fundamentals of the business. Do I think it's a scalable business that can grow? Do I have any kind of expertise in the area, or do any of my co-investors have expertise in that area? I'm not a big fan of, a lot of people will say I'm an agnostic investor. So, I'll look at anything. I think that's dangerous. I mean, I think unless you've done a good amount of research in the industry, or have spent some time in that industry, or can surround yourself with people that know the industry, that's probably not a good idea. So you're not going to jump into something you don't know a whole lot about. So if you're willing to do the homework, I mean, that's a whole different matter, right? Because that's another industry then that you can learn and can be active in. So I like to look at things in financial services. I don't mind some things in the area of renewables, because I have some co-investors that are very strong in that space. I think those are probably the two strongest. Now, when it comes to actual commercial products, whether it's a food product or something along those lines, I also have in the group that and when I say co-investors, it's a group of about 3 or 4 of us that get together and sort of dissect these deals, and then we look at them, and maybe on this particular investment all of us invest, or on the next one maybe only 2 of us do, because the other 2 just, it's not where they want to be. But by sort of having a mini board of directors, if you will, that sits around and makes decision, everybody's making their own investment ultimately. We're not jointly owning anything, but we do it as a group, because what it does is it brings expertise together. And as I'm sure Jacob has in all of his classes will tell you, information is key in making investment decisions, right? The more you know, the more successful you're going to be. If you're just playing the swings, that's a whole different matter, right? So you can't really do that in angel investing, because it's really good. It's going to be pretty early on in the business. So when I mentioned safe notes earlier, safe notes are essentially subordinated loans, right? And so what effectively the business is doing is we're financing it by way of debt, but there's a pass on any interest that's due. So they're not really paying any interest on that safe note. Safe notes are usually used in pre-seed investments, because valuations are really, really hard to come by that early in the game. Vast majority of angel investors like myself are going to get involved at a pre-seed level. Once something is out to a Series A or a Series B, that's a whole different group of individuals. The ticket is a little bit higher. In general, pre-seed is probably going to be anywhere from $10,000 to $25,000. And so, and I'm talking about businesses that some may have already established a reasonable presence out in the marketplace, and some are still completely unproven. So, again, at that point, you want to get comfortable with the business, that you want to understand whether or not, as an angel, you'll have any ability to be involved in a mentoring or advisory position, whether that's of interest to you or not. And then ultimately, and I think what becomes the second most important thing when looking at these types of investments is you've got to really understand the founder, right? So the individual who's pitching the deal, who's selling the deal, who is going to execute on the business. I've met a lot of entrepreneurs that are really good at raising money. They're exceptional. They have an ability to coalesce around 20, 30 investors that'll just write really large checks. But when it comes to execution, they can't get out of the fundraising mode, right? So they get to the point now where they've raised the money. Now they've got to go do the business, and that doesn't happen. So you're looking for someone, ideally, you're looking for someone who's been around the track once. And being around the track once is an entrepreneur who maybe has already had at least one venture out there, whether it succeeded or failed, quite honestly. And in some cases, I like to look to entrepreneurs that have at least failed once. Years ago when I was in banking, I remember one of my bosses asked me if I had a large commercial credit go bad. And up until that point, I'd said, I've never had a loan go bad. I mean, every loan I've made is that we've gotten paid back on. So I'm very proud of that. And he said, okay, well, you're not a real banker till you've had to work out of a problem, right? A loan that's going bad, or even one that goes bad, because psychologically that's going to change the way you do things. And I think the same thing occurs with entrepreneurs. If they've had a loss, for instance, it's going to change the way they approach their next transaction, their next opportunity. And when they bring that, I think they come with a new set of skills and a new set of knowledge of how to do things going forward. So for me, it's typically anywhere from 2 to possibly 3 interviews with the founder. I may talk to who they currently have working with them. If it's usually people on a part-time basis, because if it's pre-seed, they probably don't have a lot of money to burn through at that point. And really just get a feel for their plan for where they think the leverage points are in bringing the product or service to market. So I think I like services a little bit more than products. I have fallen in love with some products and invested in them, and then ultimately not been very happy with that. But that's kind of the deal, right? I mean, so you just sort of look to at the end of the day, you want to invest in things that you're interested in. It's not purely a play on something that from an economic standpoint might make sense. I think the only time you would diverge from that mantra of investing would be if the founder is just so well positioned with a product or a service that you're maybe don't have as much interest in, but at that point you're 100% betting on the jockey, right? You're not betting on the horse, you're betting on the jockey. And there's a lot of that. Some angel investors just really bet on the jockey. And when I said that they are agnostic about what they invest in, that's what I mean. It's just really more looking at the founder. Are they able to execute, and what are they able to accomplish in that point? But so what I like about Bama is, as an organization, is that we obviously are looking for female or minority founders. And one of the statistics that I find appalling is that in I believe it was 2018 was the last time the number was looked at, but less than 3% of the private equity money out there goes to female founders. So it's a big space. We can say the same thing about minority founders. So myself and my co-partner, my investment partners, if you will, like that space. We've done obviously some things outside of that space, but in general, that's going to be our focus, because we just think that there isn't enough capital in those spaces, right? And we'd like to foster growth there, and then serve as advisors and mentors to those individuals. So so that's primarily what I've done with Bama. In terms of property investment, I think right now, one of the things that I'm seeing, and I've sort of laid off property investing for about the last 12 months. Well, that's not exactly accurate. I did a deal in January, but I mean, I've done less than I normally have been comfortable with doing, and that's because we've had just a skyrocketing effect on property values. And so my concern is that assets are trading just much higher than they need to be trading for. I don't know that I believe the values, but it's getting harder and harder to not believe that they're going to at least sustain. Now, the wrench that you throw into all of this mechanism is inflation, which is going to have, I think, a couple of knock-on effects really in any investment decision, right? Because if you're talking about maybe making an investment in the S&P 500 or picking a diversified EFT fund, then you're going to start looking at where inflation hits as a basis against what your overall rate of return is, because your real rate of return is going to get eroded by any inflation. So inflation becomes really important. In the property game, I think what we're starting to see here in Houston anyway, and in some other cities in Texas and in the US, is more inventory coming online. You've got a lot of owners of real estate that have sort of been holding on to properties because I think with rates having been as low as they've been, financing being easy to obtain, it was, and there was less on the market, and so properties were obviously selling for a pretty good premium. Now, with the introduction of inflation into that equation, it makes borrowing a little bit more challenging, right? So you start to flush out some investors immediately who are working on margins that are too thin. Because as an example, if you're looking at an apartment complex that's 12 units, right, and you've got a margin in there built in where you're going to net out maybe 10% a year, that the inflation rate's going to kill you, right? So now I think what we're starting to see, which we hadn't seen in a little while, is almost a flood of properties coming online. Not necessarily at a discount yet, but definitely more inventory is out there. And that's because if you currently own a piece of property, commercial or otherwise, and we're thinking about selling it, right now is probably the best time. Because what's going to happen is inflation is going to increase the cost of borrowing, and it's going to make it a lot more difficult for you to have, as opposed to having 5 qualified buyers ready to buy, that may drop down to 2 or maybe 1. And if it drops down to 1 or 2, you're all of a sudden aren't in a you don't have individuals putting in multiple contracts at different levels, increasing the value or increasing their offer price, and then you could easily not get what you were looking for. So I think what we're going to see is, especially when this next rate increase happens, the Federal Reserve here in the U.S. is talking about 8 increases, right? So I think as we get further into those, into the 3rd and 4th increases in inflation, if it doesn't get tapped down some, I think you're going to see more property come online, and you'll see some of it perhaps even coming in at a discount, because at that point it's like all the rats kind of jumping off the ship, right? Because everybody's trying to get out. And what happens is you could end up not necessarily a fire sale, because I think a lot of this depends on the strength of the U.S. economy, and we could have a whole different discussion about that. But the depending on the resiliency of the U.S. economy and its ability to avoid an actual recession, which is becoming a real possibility, then maybe things in property remain reasonably stable, but with more inventory on the ground that can be sold, and investors can buy. So for me, I see the opportunities in property. What we're in now, clearly into the second quarter. So I think definitely the 3rd and 4th quarter of this year is going to present some opportunities, particularly in the multifamily space, in the small multifamily space. It's been a crowded marketplace. You've got every investment bank now in property. You've got private equity funds backing companies like Tricon Real Estate that own 4,000 or 5,000 single family homes that they rent out. So it's no longer kind of a mom and pop business, right? You got to really do your homework, just like angel investing, and find those deals that work for you, and make sure that the return works for you. The thing about real estate that I think you have to always remember is I never look at it as a short-term play. For me, it's a long-term hold. I think that over time, it's a good asset to hold on to, particularly if it's developing a revenue stream. Speculation on land is a totally different game, and I don't do that. I'm typically looking for assets that are generating some sort of rental income, and hopefully that it's in a state that needs some level of improvement, to where if I do that, then I can increase the yield by increasing the rent. So I think right now, as an investor, both on the angel side as well as on the property side. I'm really curious to see what Chairman Powell is going to do and whether or not his ability, I should say the Fed's ability to increase rates is really going to tamp down insurance, because it could, I think my guess is, what do you think, Jacob? Maybe by October, November, we'll have a really good sense of what 2023 through probably the next 3 years is going to do. What do you think?
Thank you so much. Shall we just ask some of the students to ask questions? I think we have some questions coming in. The first one from Max. You wanted to know, go ahead.
I just wanted to know your strategies to your property investments, what your outlook is on it.
Could you hear the question?
Can you repeat it for me, Jacob?
Yeah. Max, one of the students, is asking, what is your outlook for your property strategy?
My outlook is I'm bullish. I'm bullish right now because more inventory is coming on the ground. I've been actually holding back what we would call dry powder, right? Dry powder just means, money to invest, if you will. I think that, but I think it's how we do these deals going forward that's going to be important. I think it's going to be a combination of debt and equity, probably slated maybe close to even 50-50, which is not typical, right? I mean, normally you're going to see 20% debt. I'm sorry, 20% equity, 80% debt. But at borrowing cost, being at the risk of rising as high as they are, I'd rather half my borrowing costs by putting in more equity. I'm okay with that. I understand that from a gearing standpoint, from a yield standpoint, I'm probably not going to do as well. But the adjustment can come later on when interest rates readjust. So I feel that the entry point is coming in with a good mix of debt and equity. I think I like the small multifamily space here in the States. By that I mean anywhere from 8 to 24 units. I think there's a lot of value there, and I think we've got a lot of landlords that have been holding on to those properties for a good while now. I hope that answers the question.
I think so, yes. What kind of returns are you expecting going forward? I mean, we talked about inflation here. We see inflation coming, kicking in. Has this changed your return expectations?
So years ago, I did a project for Jacob where I think I built in. He used to have a project where you had to do a diversified portfolio of investments, and so obviously I picked I guess it was a number of stocks, a small bond portfolio, and I included a real estate investment, which I was actively doing at that time in 2009, and it was mobile homes. I think that's what they're called in the but it's a mobile manufactured home, and there were these deals I was doing with my father. We just essentially buy a residential lot and put a trailer on there and then rent it for $1,000 a month. So, because we were able to pick up the lots at really an inexpensive amount, and the trailers we were buying and rehabbing, our return was something like, I want to say close to 18-19% a year. And I remember Jacob said that wasn't reality. And that I had to go in and readjust my numbers. So I showed him to him. He goes, "Wow, if you really think you can get that, then you need to do it." And so we continued to do that. But that was a unique situation. I think I've got probably, if you're looking at capitalization rates right now on multifamily, they're probably anywhere from 6 to 8%. I personally like something closer to 10. You're only going to get that if you buy something that you've got to do probably a considerable amount of work on, go in and rehab, because building in what they call sweat equity into a deal like that enhances the value, because at the end of the day you're deriving your revenue and your return based on the rent. So if you buy a property that is let's say the rent is $1,500 a month per unit, and you're in a situation where you can't raise those rents because there's nothing you can do to the building to enhance it. Well, I mean, that's as good as it's going to get, right? I don't particularly like those deals. I'd rather go somewhere where the rent is currently $1,400 a month. And if I put in washers and dryers into every unit, and if I maybe paint the building and do some landscaping and things of that nature, I can be at $1,750 a month, right? So then that's something you want to hold on to and then you can do something with it down along the way. So so ideally, to answer the question, I like something closer to 10 or 12. It's getting harder to do, and obviously with inflation impacting, that real return is probably going to get eroded down to probably closer to well, it's just going to depend on the inflation rate, but we could end up, somewhere around 6. But keep in mind that's 6, but you're still getting the return in cash, right? So I think the thing is to capitalize on the opportunities. Don't get too hung up on your return rates in choppy waters. If you're holding the asset, and if you can sustain it, by that I mean debt service associated with it, and keep it rented. When you come out of this on the back end, that's when you'll see, a significant return if you were to sell or to trade up for a different building or investment for that matter.
I think we have another question.
Is there a lot of commercial real estate that we invest in?
Yeah, are you more investing into commercial versus resi, or do you have any?
So here 4 units or more is considered commercial because it's a multifamily unit. I don't do if by definition of commercial you mean commercial buildings, strip centers, things of that nature. That's not really my my content area. I think historically I did one deal like that with my dad, and that's the only. So it's a little different for me. I kind of like the multifamily space. So the way I think you're asking the question, the answer is probably residential, because you would probably call all so yes, residential.
I was just wondering that because the commercial always have longer rental terms.
Yeah, because obviously the
I think in Switzerland there's probably different terms and agreements you have with the
What was the question?
So no, one of the questions, of course, is like in England we have these shop fronts and so on. And one of the students here is from Switzerland, where it says in Switzerland, when you do commercial, it's very different in terms of income streams and so on. But I think you specialize more into the, as you said, multifamily, which is considered commercial, but and so on. But just perhaps a few questions around, like what you're doing and what's happening in Texas at the moment. Of course, we know Texas as a, oil and gas over there, very important industry. It's one of my research interests, of course, as you know. I've looked a lot into this particular oil and gas that was developed and discovered in Israel like 10, 15 years ago. And then the other question, of course, would be around high tech. So what you see in terms of entrepreneurship around oil and gas, which is more like value, versus high tech, which is like a growth industry.
So yeah, absolutely. You can't not talk about oil and gas if you're in Texas. And so I think what's interesting in oil and gas is prior to the conflict in the Ukraine, and still today, obviously, there's a lot of emphasis on the part of the majors, and by that I mean BP, I mean Shell, I mean Exxon. To make the shift to renewables, right? So you're seeing heavy investments in like wind. You're seeing heavy investments in solar. That's going to become a bigger part of their business. They're investing in battery technology and charging technology. So they don't want to get left behind. Now the obviously, and I don't believe they're going to. I think one important thing to remember, though, is all the assets that they've jettisoned that are primarily in the, say, exploration space, somebody else has bought. So whether that's a mid-sized company, a small cap company, exploration company that's bought it, all that oil and gas production is still out there. It's just somebody else owns it. If you've got an activist investor, like Bill Ackman. By the way, Bill Ackman's no longer going to do activist investing, Jacob. I don't know if you saw that this morning, but so if you got Ackman coming at your company, like a Shell, for instance, or I think it was Fire Engine or Red Engine number something that was protesting Shell for them to get out of the fossil fuel business. So they sold some assets, but they sold them to somebody, and that person, the people that bought them, didn't stop producing oil and gas. So I think the notion that we're going to be out of oil and gas production immediately, and by immediately I mean in the next 5 years, really is not the case, right? I mean, I think it's a stepped approach, and I'm a complete advocate for the renewable space, but I just think you're not going to make that leap that quickly when you still have a lack of development for infrastructure in a large part of the world. Can countries like the United States and the UK have chargers at every petrol station or at every Starbucks? Yeah, absolutely. We can do that. We can probably do that in 5 years or less. But that's not going to happen in every place in India. That's not going to happen in every place in China or Bangladesh. So, I mean, it's going to be sort of a bridge, right? You'll see these things accrue over time. My wife has an electric vehicle, a full electric vehicle. One of the hardest things to deal with about that vehicle is we can't go more than 200 miles before she's got to get a charge. So, the infrastructure isn't built out yet. I mean, I think it's incredible technology that's going to have, I would be putting money in that space, because obviously that is the future. That's like, it's almost like we're sitting around a table right now and someone's talking about Thomas Edison and that he's about to launch his light bulb, right? He, by the way, founded General Electric, and us sitting and saying, oh no, this is, that's not, it's never going to happen. Candle power and gas power, that's and gas lamps are what we're going to do forever, and it's just not the case, right? So I mean, I think right now the renewable space, it's going to happen. It just has to happen. There's no other way around it. There's just too much behind it. What's happening right now, the reason oil is above $100 a barrel is because production has been shut off. Russian oil can't get out, and there's just a general consensus and a general fear that there won't be enough oil and then natural gas in the UK in the winter. So, but like every other world conflict or political instability, those things should flush out. So I think, if anything, I think what this particular incident has done is it motivated more countries who were maybe slower to move on to a renewable track, and now they've expedited. They don't want to be reliant on countries that are unpredictable in their ability to supply, right? So, I mean, if you're energy independent, that's a huge deal, right? The United States was very fortunate that in the last run-up, they became energy independent. So we, they import very little Russian crude, right? So it's not that big of an impact. The price is still going up because here in the States to up to, I think, $6 a gallon in some places. But that's because the market is dictating that price. And you guys all know, you're in finance. You can't control the market. You can't even outguess the market, right? I mean, that's not the way it works. So, but in terms of oil and gas, I think that's where I think that's where everything's headed. I think oil and gas companies are going to do real well during this time period, obviously, because of the cost. They'd rather have a more stable price, to be quite honest with you. But they're not going to. I mean, if someone wants to pay you more for a bottle of Coca-Cola, you're going to take it, right? So, but I think a more stabilized price would be what they would rather see, so they can then do their capital expenditures. You can't bring enough production on in dormant wells right now to meet the demand. So everybody thinks it's really easy to just turn on the spigot, and all of a sudden, in Texas and California, you've got another 100 wells producing X amount of thousand barrels a day. Doesn't really work that way. There's a lot of there's a lot of capital expenditures that need to go into getting those wells operating again, because when a well is shut down, it's basically everything's sort of taken away. So yeah, I think the next 6 to 9 months, however long it takes to stabilize this situation, is going to be sort of jumpy. I think I'm curious to see what Europe does with gas ultimately. I think what we're seeing Germany talk about is interesting on self-reliance on theirs, or even rationing to be prepared for that. So it's an interesting space to invest in. It's an interesting space to be involved in. But it's susceptible to political risk, right? And that's what's happening right now.
What about high tech? Just a few words about high tech in technology investments in Texas. What do you see over there, particularly on the early side in seed and in development stage and so on?
So I think what's happened in Texas, and you probably have Elon Musk and everybody. So if you're not familiar with the demographics of Texas, they're changing dramatically. Cities like Austin, in particular, are seeing an influx, a huge influx of individuals from California, because housing prices in California are extremely high, and Texas is reasonably affordable. And Elon Musk moving his what is it, a space a program here into the valley, and I think he's done moving some of Tesla here as well. So the investment ecosystem in Austin is now akin to what you might find in Silicon Valley, because a lot of those folks are moving over here, right? So Texas is trying to build out. I think you see from the government, the state government, a lot of government-sponsored incubators and accelerators. So the actual physical construction of new facilities where entrepreneurs can go, and some, for example, Greentown Labs here in Houston, which is specifically dedicated to entrepreneurs in the renewable space, and the Cannon is another, and those are for individuals in the tech space. So I think it's a very vibrant community. It's growing immensely. One of the things that Texas has always had is it's been a reasonably affordable place to live. You've always been able to find jobs. You've always been able to find housing. Oil and gas propping up the economy, I think, has helped that. And so I think people now are the one thing I've always complained about living in Texas, and I was born here, is it gets hot in the summer. I mean, really, really hot. And so, but I think even people from California are willing to put up with the heat because of, what they're able to get here in terms of house value. So with them comes a mindset of investing in tech, completely different. If Elon Musk is here, others follow. So, there's a lot of traction now in Austin in particular with investment. So as a space, I think you're going to see a lot more coming out of Texas, and in particular coming out of Austin. Out of Houston, you would probably see more along the medical technology space, because if you're not familiar, Houston has one of the largest medical centers in the world and has always done a lot in medical technology, and probably will continue to be at the forefront of that. So those are some areas that will probably see some continued growth and investment.
Ed, thank you so much. I think we're coming to an end. I think we're almost an hour into our talk. Thank you so much. It was fascinating to hear from you. Obviously, your background, but your investment interests in the different areas. And then, of course, what you painted most recently is, about the oil and gas and technology side. So thank you so much for your time. Hope to see you soon, either here or over there. I'm going to be in California anyway over the holidays. I'm not quite sure I come over to see you, but
well, I might come over to see you. If you come all the way over here, I'll go to California to see you. I think I'll be in London the first couple of weeks of June. I don't know when you're coming here, but I'll
come. We stay in touch. Thank you so much. I think we really enjoyed to talk with you. Fantastic speaker. Thank you so much. And a round of applause for you. Thank you so much.
Thank you very much, guys. You guys have a great day. Have a great afternoon. Thank you.
Bye-bye.